Petty cash funds. What is a petty cash fund? Most disbursements of cash by companies are made with either a check or an electronic transfer in order to act as a basic contractivity which a company can track outflows of its cash. However, situations arise where minor amounts of cash are required for expenses where using a check would be impractical. In situations such as these, the petty cash fund is used. A petty cash fund is a small amount of cash kept on hand to pay for minor expenditures. Operation of the petty cash fund. The operation of the petty cash fund follows the same three activities for all companies: establishing the fund, making payments from the fund, and replenishing the fund. Establishing the fund. A petty cash fund is established by writing a check for the amount needed, cashing the check, and placing the cash under the care of a custodian. Following this, a journal entry is made to record the establishment of the fund. The petty cash account is debited by the amount of cash used for the fund, while cash is credited with this same amount. The entry effectively increases the petty cash account and decreases the cash account, having no effect on total assets. Making payments from the fund. The cash in the petty cash fund is used to pay for qualifying expenditures. Payments are made usually in two ways. Cash can be taken directly from the fund to make a payment, or employees can seek reimbursement from the fund for payments they made personally. Replenishing the fund. As funds in the petty cash fund decrease, it must be replenished. The amount of cash needed to replenish the fund is calculated by subtracting the amount of cash remaining in the fund from the original balance of the petty cash fund. This amount should be equal to the total amount of receipts. The following journal entry for the replenishment of the fund is as follows. All the expenses are debited in order to increase expenses, while cash is credited in order to decrease the cash account. Cash over and short. The amount needed to replenish the fund should equal the amount of receipts. However, this will not always be the case. The custodian may not obtain all receipts or give incorrect change, causing a discrepancy. This discrepancy is charged to the cash over and short account. The cash over and short account is a temporary account that can have either a credit or a debit balance in order to decrease or increase expenses respectively. As seen in this example of a petty cash fund replenishment report, the total receipts for expenses do not add up to equal the amount of cash that is needed to replenish the fund. A total of $125 is requested to replenish the fund, while the receipts add up to a total of $123. This $2 discrepancy is charged to the cash over and short account. Thus, in the following journal entry, the cash over and short account is debited in order to increase expenses so that it matches the amount of cash needed to replenish the fund, while the cash account is credited in order to decrease the amount of cash.